Hi, everybody. Thank you very much for joining us. Welcome. This PKF Tax Update is part of a series of webinars that we've been running as PKF South Africa with a focus on our people and our future. And this tax update is meant to be exactly that, a focus on the future of revenue and tax collections, looking at steps that SARS and National Treasury will be taking over the course of the next year or so, particularly in light of the decline in revenue collections due to COVID and the following economic lockdown. My name is Ziyaad Moosa. I'm one of the partners at PKF Octagon. And with me this morning, we've got the members of the PKF South Africa Tax Committee with representation from the majority of our offices in South Africa. We've got from PKF Durban, we've got paul.gering. Paul is really the doyen of the PKF South Africa Tax Network. He's got a wealth of experience ranging from lodging of objections through to SARS disputes, taking these all the way through to tax court. And Paul is also primarily responsible for the publication of our PKF Budget Tax Guide, which is a network we proudly get out on the day after the budget each year. From PKF in Port Elizabeth, we've got Deon van Zyl. Deon heads up the tax department in that office, and he's responsible predominantly for VAT, PAYE, and employment tax incentives, or ETI. And that's particularly relevant in the current environment, given that we've seen a number of changes to the ETI claims based on some of the SARS COVID relief measures over the course of the last couple of months. And last but not least, we've got Alexa.muller from PKF Cape Town. Unlike the rest of us, Alexa is a lawyer by profession. So she's got to focus predominantly on corporate tax restructuring, general tax rulings, legal opinions, and tax efficiency structuring and the like. So welcome, Paul, Deon, and Alexa. Really looking forward to hearing some of your comments, particularly around policy changes over the course of the next year. But just before we get started, a couple of short formalities. We are running this as a panel discussion. But if you do have any questions, please just drop those into the chat box. It's the links down at the bottom, and I'll pose those to the respective person. We'll also have a little bit of time permitting. We'll set aside a little bit of time at the end of the session for a few questions if there are any. So as and when you've got anything that you need to ask, please just drop it into the chat box. Following on from the session, there'll also be an email coming from the PKF South Africa marketing team. So if you do need a CPD certificate for the session, please just respond to that and we'll gladly issue you with one. It will be for an hour and it will be tax specific. And lastly, there will be a recording made available of this webinar as well. So if you do need to rewatch or share it, please feel free to do so. We would just advise a lot of the discussion during the session centers around future tax policy, a lot of legislation that's not yet enacted. So please just bear that in mind if you do rely on any of the advice. We would just advise that you consult with a tax expert before implementing any structuring changes that you may consider out of this discussion. So like I said at the start, this discussion does primarily focus on policy and expected changes over the course of the next year or so. But before we sort of understand where Treasury is going and where SARS is going to be looking over the course of the next year, I think it's important just to understand where we're coming from a revenue collection perspective and what our overall framework looks like from a policy perspective and where our key sources of revenue are in South Africa. So I'm going to put up a slide, and it's really not going to be death by PowerPoint. This is the only slide as part of the presentation. So in South Africa, we look to collect roughly 1.3 trillion rand a year, and that's made up of a couple of key sources. We've got personal income tax, where we collect on average just under 400 billion rand for the year, making up 30% of the total pot. We've then got VAT at 324 billion, which is roughly a quarter of the total revenue collections. The third key source of revenue is corporate tax at 214 billion. And then we've got this other pie of collections, which comprise the fuel levy and customs and sin taxes, transfer pricing, or transfer duties, estate duties, and the like, making up the balance of collections. Now, the minister tabled an adjusted budget speech about 2 months, or a little bit over 2 months ago. And as part of that budget speech, there were some interesting stats that were shared by National Treasury, particularly relating to how these collections have performed. And I'll put those up. If we look in particular at our VAT and PAYE collections, the red line is the 2020 numbers, and the remaining lines are our collections in prior years. And clearly, we can see that there's a major drop-off as soon as COVID hits in March. Pretty much the entire economy was devastated, and that follows through to our tax collections as well. So we're significantly down on previous year collections. Edward Kiswetter, the SARS commissioner, came out with a statement towards the start of the lockdown saying that SARS is anticipating being down by roughly 300 billion rand in collections against budget. But I think it's important to put that in perspective as well. So going back to our pie as well, effectively 300 billion rand is the equivalent of taking out the entire VAT collections for the year. And that's 25% of our pie, and that's a massive hole to fill. Now, to contextualize that, 300 billion rand is a big number. I mean, I struggle with the number of zeros, but to put that in perspective in terms of what we could buy, we could effectively put up 5,000 schools at a cost of 13 million rand a school. We could staff those schools with 85,000 teachers, and that would increase our school network by about 20%. There's about 25,000 schools in South Africa at the moment. In addition to that, we'd be able to put up low-cost housing at 100,000 rand a house for about 1.5 million South Africans. And we'd still be able to double the child support grant at a cost of about 70 billion rand. After doing all of that, we'd still be left with about 2 billion rand in change, which is enough to build an Kandla 10 times over. So a massive hole, 300 billion rand, is certainly going to influence economic policy and tax collections over the course of the next year, and that's without a doubt. I think if we look at the job stats as well that were published by Stats South Africa, we've lost about 2.1 million jobs in SA. Again, to put that in perspective, that's pretty much the entire population, or more than the entire population of Port Elizabeth. So to contextualize, it's almost as if everyone in PE is now out of a job. So those are scary numbers, and certainly are going to influence government policy over the course of the next year. And I think, Paul, from an economic perspective, certainly we are going to see changes in policy over the course of the next year.
Well, certainly we hope so. Even to get us back to where we were is not enough, because we had an exceptionally high level of unemployment and we had a very, very low level of growth. So even to get back to where we were is going to be a mountain to climb. And government certainly needs to do something, and something dramatic, and something soon. And there are many things that they can and should be addressing, but I think the key thing that they must look at is the electricity supply. Because even during the lockdown, we had alerts of electricity shortages that were going to be coming, and the blackouts that followed. And that was when we had very, very low economic activity. So the time is now ripe for those public-private partnerships to develop other alternative forms of electricity and allow us not to be so dependent on the Eskom services, which are not dependable in the start. So that's the first and critical thing, to get the economic activity going with a backbone of electricity as its supply. But government also needs to curb, in dramatic terms, the level of corruption. It's all very well that we have these commissions and we have people highlighted as being corrupt, but we need to have some serious action. Otherwise, people think this is a never-ending saga and discussion, but no action. People must be arrested. People must not be given state support funding to fund their own defense. Otherwise, we have the situation that we have with the previous president, who's been using state money to defend himself and keep him out of the whole process for all of these years. We need swift justice. We need proper justice, and we need to see a stop of corruption. The ANC has said many times, if their officials are involved in corruption, then they must lose their office. But we don't see that in practice. We need the words and the actions to be in symmetry. Now, those are two big structural things that government as itself must do. And the third thing that really is necessary to fill the gap is for SARS to look at its enforcement. So SARS and SARB must look at their enforcement properly. we had a first foreign exchange amnesty. And when that happened, we said, wonderful idea, but not enough money was raised. And we put pressure for many years on a second foreign exchange amnesty. We got a something on the foreign exchange, not an amnesty, but a voluntary disclosure regularization program. And at the start of that, we said, this is not enough to bring in all the money. And so I'm sure that there is more out there that has not been regularized. And as Judge Davis said during this whole debate about the second amnesty, the time has now come for those people who have chosen not to take advantage of the amnesty to have the full weight of the law thrown at them. We need to have a regularization process, one way or the other, with the foreign assets. We've had 2 amnesties. Now's the time for some proper action by SARS. And if they don't believe they've got the ability to do that, it's time for another amnesty so that we can regularize all that's offshore.
Well, we've also had this discussion on an ongoing basis about the public sector wage bill, but there doesn't really seem to be the appetite to reduce it dramatically. I think the minister, again, in the budget speech, probably had 2 minutes or one line in the speech about it. Do you see much change from a political will perspective to the public sector wage bill?
I think the minister probably has the will to do something, but I don't think he's supported by his colleagues. I mean, there are 2 issues. There's firstly the rate of increase that the public sector is going to get, which will be significantly higher than the 0 increase that the private sector will be giving during this COVID period and probably for another year. And second of all, the number of people that are employed versus the number of people who are actually working or needed in the state. And I think those discussions are serious discussions that need to be taken. But I don't think that the political will to address that is there. And that is unfortunate.
Deon, Paul's chatted a little bit about some of the stimulus methods and some of the areas where government needs to cut. But I would imagine that that's not going to be sufficient to fill the hole that we were talking about a little bit earlier. From a SARS and Treasury perspective, do you think there'll be an appetite to start looking at new forms of taxes, or will it just be a view that Treasury will take in terms of increasing existing rates?
Yeah, I mean, Ziyaad, you know, it's a very difficult one. Firstly, if you were to look at VAT, you know, it's quite a tricky one to do. We've got municipal elections coming up, and we've seen previously that they hold off on the increase when we move from 14 to 15%. And I think the increase on VAT is really quite a difficult one because it affects the poorest of the poor. You know, I think what happened last time when we had the increase to 15%, we had the implementation date, and only subsequently that we, you know, come out with a new list of zero-rated items. So I think if they were to do that, they need to broaden the scope of the zero-rated list. And also then they need to weigh up, you know, how much are we actually going to collect more by having more items scoped out as being zero-rated. So I think that's the one. So I don't think we'll have that, but if they were to do it, they're going to have to do quite a significant exercise, and they need to get the timing right. They need to get the list sorted out before they do any increase. You know, if we were to look at personal income tax, you know, there were quite a few retrenchments. So I think the number of employees contributing to personal income tax, that is reduced. I mean, Paul just mentioned that the increases definitely in the private sector is going to be down. You know, there's obviously debate around a public wage bill and how that's going to be dealt with. The money flows out and some of it flows back into personal income tax. But again, it's a very difficult one. The working class, those that still work, and just by the way, I know you sort of deliberately picked on P, but we still have a few people here that work. Not all of us are staying at home. There was quite a bit of traffic on my way here this morning, so I just want to set record straight for discrimination against P. I'm just joking, but you know, obviously, you know, I think everyone's felt it, and there's certain industries, obviously, that will probably, you know, take a lot of time, if at all, they're going to recover. I think the one area, you know, one's got to look at perhaps is in the area of wealth taxes. You know, the Davis Tax Committee have spoken about this on numerous occasions. There's been murmurings in the press, and every year the budget speech comes out, we sort of look at it. Yes, there were changes to, you know, Section 7C, which really deals with, you know, basically the concept in the past where assets were transferred out of a personal estate and into a trust, and often it would have been a sale and loan account, and typically it would have been a low interest rate So, or no interest charge at all. And in that manner, obviously you could, move assets out of your estate. And so I said, well, if you're not going to charge interest, you're going to have an annual donations tax charge at the official interest rate. So obviously there's been a move towards that. Whether they're good enough in collecting it, so I think firstly, the SARS will need to improve the system at the moment. If you want to make a declaration for any donations tax, it's a manual form. At the moment, dealing with SARS is a bit of a nightmare because they've gone over to these virtual meetings. But we do find in practice that not everyone at SARS exactly know how this works. And if they can probably move that onto e-filing and just could correct the mechanism, that will already go a long way. The other thing is the implementation of Section 7. So what we're talking about here is just doing, there's something that's been in the Act. It's a so-called attribution rule. So just by means of an example, a father would probably donate or sell a property to a trust. And because of that donation or settlement, now there is rental income that goes and we vest it in the minor beneficiaries. So as a result of that disposition, there's income now flowing to the minor children. But we don't often see that SARS actually attacks this and attribute the income to the father that's at the higher tax rate. So there's mechanisms like doing 7C properly, which I spoke of, and these attribution rules. So if SARS were just going to implement these and enforcing those, they don't necessarily need to go and change the law. But in terms of adding on the wealth taxes, there's the whole debate around how do we deal with donations between spouses. At the moment, these are exempt. But there's been talk about possibly stopping the tax-free or transfers from one spouse to another without triggering donations tax. That's always been there, but I think SARS is probably going to look at that, and that might be something that we could see, and probably we'll see that change rather than the change in estate duty, because I think if you were to change the regulation in respect of estates where you typically bequeath the residue of your estate to the surviving spouse, I think that will cause quite a bit of a stir and quite a few wills will need to be redone. So, the only other thing one could possibly look at is maybe dividends tax. We're already at 20%, which is higher than other jurisdictions. I don't necessarily foresee a change there. We're already at 80% on capital gains tax for trusts and companies. If we go up more and we get to 100%, the whole debate of revenue versus capital, and, that sort of falls away. So those are sort of just my thoughts in terms of where to go. So I do think maybe on the estate side and maybe a combination of, donations tax between spouses, that inter-spousal donation might be an area to watch out for in maybe the sort of February budget and where we get to.
Deon, as part of the President's Advisory Council on COVID generally, there's also been this economic advisory panel that's been making a few recommendations. And I think there are some murmurings as well in the market that a few of those recommendations relate to either a wealth tax on assets or alternatively the sort of solidarity tax where we'll see a temporary increase in rates for high income earners over the course of maybe 3, possibly even a longer period of time. Do you see that coming to the fore, and do you think it's sustainable? I mean, we know at the moment that a very large percentage of PAYE is contributed by a very small pool of high net worth individuals.
Yeah, I mean, a solidarity tax, I mean, there's already so much taxes being paid. And I think, there's a lot of pressure already on those that are still, having, a job and their contribution to the economy for government to do a 3-year cycle and call it a solidarity tax. I wonder if they would be able to do it on such a short term. And perhaps if they were to introduce something, you'd probably see a longer term, because once they get used to it, would they actually have the policy to say, okay, we're only going to do this temporarily and move away from it? So, the other thing with the wealth tax, it doesn't contribute all that much at the moment. Maybe they can look at it and see how they can tweak or change it. But if you look at your contributors to the overall collection and your pie chart from earlier, you look at VAT, you look at personal income tax, and you look at, normal corporate taxes. So whether that will actually contribute like they want to, we don't know. But yeah, maybe if they were to tax you on some sort of different basis, we never know if they might introduce something new. But, it's difficult. I don't know if any of the other panelists have a comment on that. But I'm sure next week maybe we'll find out a bit more when we've got the midterm budget speech.
Well, we did have, at the time of the New Democracy, we had an RDP levy for, I think it was 2 years, that came through as a special additional over and above your normal tax burden. So the concept has been there before. But on the issue of the wealth tax, I mean, it's emotional and it's highly politically charged. But, you know, we have a wealth tax at the time when we pay our monthly rates. It's based on the wealth of our properties. We have a wealth tax every time we sell shares. It's a marketable securities tax on the value of the shares that are sold. We have a wealth tax on the capital gains that arise from those transactions. We have a wealth tax when we make a donation, and we have a wealth tax when we have a death and estate duty. So wealth taxes are already in existence. They might not be called a single wealth tax, but tax on wealth already exists.
Yeah, Paul, I think, as you say, it makes the right noises from a political perspective, because a wealth tax is certainly the populist move. Whether it is feasible or the amount of revenue that will actually be collected for it, I suppose that's debatable. Alexa, I think Paul and Deon have touched a fair bit on changes in the VAT space and in the personal income tax space. But there's also corporate taxes where we collect a fair bit from. Do you see changes coming through in that sphere as well?
Yes, I think in February, before the impact of COVID was felt, the minister indicated in the budget speech that they would actually be looking at reducing the corporate income tax rate. And they mainly stated that because they acknowledged that in comparison to our investment and trading partners, the South African corporate income tax rate is very high. For example, the US, the UK, and India have tax rates ranging, corporate tax rates ranging from about 19 to 22%. So for the average South African company paying corporate tax at 28%, it makes it a bit more difficult to compete in the global market. So in acknowledging that, the minister indicated that over the medium term, they may look at reducing the corporate tax rate, but at the same time, or before doing so, they were looking to expand the corporate tax base. In other words, to increase the pool from which corporate tax is levied. And some proposals were made to increase the corporate tax base. And in line with those proposals in February, some of the the industry-specific tax incentives were indicated to be removed, or their reach was going to be limited. And I think we saw quite a bit of that coming through in the tax bills that were released in July. So I think that's a move towards increasing the corporate tax base with a view to reducing the corporate tax rate. But the more significant changes which they were proposing to come into force have been kicked out to later dates. And those two changes relate to the limitation of interest deductibility. In the budget speech, it was indicated that corporates will be, in future, will be limited in their ability to deduct interest to 30% of their earnings. In addition, there were proposals made in relation to assessed losses. Now, SARS has for some time been focusing on assessed losses, so it wasn't surprising that there were these murmurings and proposals indicated in the budget speech, but I do think it's quite a significant change, and for that reason, that proposal has also been kicked out until a later date. Initially, both the interest deductibility limitation and the assessed loss proposals were indicated to come into force with effect from the beginning of 2021. But during a further announcement by Treasury during COVID times, I think it was in April this year, they said they will defer the implementation of those two proposals until at least the beginning of 2022. And I think particularly it's helpful in relation to taxpayers that have large assessed losses, because the proposals made in relation to the assessed losses could have drastic consequences. The proposal indicated in February states that they will look to limit the ability of an entity to use its assessed loss carried forward to 80% of its taxable income. So to give an example, if an entity has an assessed loss of 200 Rand in year 1, but taxable income of 100 Rand in year 2, it would only be able to apply 80 Rand of its assessed loss against that taxable income in year 2. So it effectively means an entity would always be subject to tax on at least 20% of its taxable income, regardless of whether it has an assessed loss or not, which is quite a drastic change for some entities that have large assessed losses and are currently facing reduced revenues. So to summarize, I think there are various proposals linked towards this intention to reduce the corporate tax rate in the future. But because these proposals have been deferred until quite some time into the future, I don't foresee, given where we are as an economy at this point in time, that the corporate tax rate can be reduced in the medium term, as was initially contemplated in February.
Alexa, we've seen across the world this trend of declining corporate tax rates. We've seen it in the UK, we've seen it in the US, we've seen it in a number of competing jurisdictions. I mean, it's unfortunate that seems to be, that National Treasury seems to be taking a different view on it. Do you think that that's the right move from a policy perspective? Because it's almost counterintuitive. The expectation was that the reduced corporate tax rate would result in additional foreign inflows and then would create this stimulus or would stimulate the economy. What do you think from a policy perspective?
I think from a policy perspective in February, it was a very appropriate proposal to make. And as you say, it will stimulate international investment. But I don't think it is responsible to reduce the corporate tax rate at this point in time, given where we are with the budget deficit. Just looking at your slide earlier in relation to the dwindling tax collections in the 2020 calendar year, it's just not the right time to reduce the corporate tax rate. And I would imagine that they would first want to see an increase in the corporate tax base before they will proceed with reducing the corporate tax rate.
I think we've dealt with sort of the three biggest sections of the pie, but there's this third other sort of collection which incorporates sin taxes. And Kelly, maybe if you can just pull up a poll for us quickly. We'd just like to have a little bit of fun with this and just understand how much people were paying for a pack of cigarettes or during the lockdown period. So we'll open it for a minute or two and just get some answers to frame the next discussion.
Ziyaad, hi, it's Kelly. I just wanted to let you know that this is an anonymous poll, so people don't need to be nervous.
Okay, so if you were paying for cigarettes, the Hawks are not going to come knocking on your door sometime next week. We'll just give it a minute or two to run. Look, I think even on those numbers, although the poll's still in progress, sort of 70% were paying way in excess of the current pack of current price per pack of cigarettes. I think it's somewhere around 36 or 40 Rand. Paul, this is, you know, got to open National Treasury's eyes a little bit and sort of almost force the discussion around whether or not there's scope to potentially increase sin taxes on cigarettes and then possibly also on alcohol quite dramatically. I mean, if we just look at our poll, out of the small session, the majority were paying somewhere at least double, some even sort of 4 or 5 times the normal pack.
Yes, well, at the last National Treasury workshop, the last session was on the sin taxes. And I made a comment that a lot of people have been buying cigarettes at far higher prices than the list pack. And accordingly, I think that the sin taxes could double. And if one looks at it in context, the sin tax was meant to pay the national health bill that arises from smokers and drinkers, and was meant to curb people's abuse of both alcohol and cigarettes. Now, the medical cost that the state pays is far in excess of the excise that is raised on cigarettes and on alcohol. And so there's certainly a scope, if one comes to the basis of why that was a tax, for this tax to be increased. There's also scope on the basis that people will pay more for these cigarettes than they currently have been paying in the formal economy. Now, together with that has to come proper enforcement of this industry, because all these people were buying cigarettes during the lockdown period at whatever price, and none of the excise on those cigarettes was being paid over to the state because there was officially no cigarette sales. So there was a thriving economy. People were not going without. Those who could pay were paying. And so the reality is there's a huge second economy in cigarettes and alcohol, and this needs to be curbed. So part of it is fraud of deeming something to be an export to Namibia, getting it across the border, and then bringing it back in as a zero-rated transaction by a reputable South African company. That is a problem. Part of it is stuff that's being smuggled in from across the border from Zimbabwe and other places. And all of this is a porous border, low enforcement, and our level of recovery of excise could certainly be significantly higher than what we have.
Yeah, Paul, it comes down to this concept of enforcement. But I suppose the counter argument to this is that by increasing sin taxes, you almost will naturally have this illicit economy blooming because there's now a bigger incentive to commit fraud and not pay those taxes over. Do you think that as a South African, as government, we've got the ability to enforce this? Because it involves many facets. It involves SARS, it involves customs. There's a number of departments that have got to work together in order to get this right.
Well, we used to have quite a good team in that illicit economy, but they didn't have the political backing. Many of them have left SARS. They've gone on their own. They've written books about what they tried to do before and what they could do if they had the authority to do it. So I think that needs to come back into the pot. I mean, Al Capone came down because of tax, not because of anything else. So they have the ability, if they can enforce the tax laws, to curb a lot of the other stuff. I mean, if one looks at corruption, there's a tax consequence. If one looks at bribery, there's a tax consequence. If one looks at the illicit economy, there's a tax consequence. All those tax consequences need to be dealt with and focused upon.
Do you think we've now got the political will to make those changes, Theo? Paul, in terms of the expectation or rather the noises that are coming through by SARS?
Look, there are some noises. It's a big question as to who's controlling the political will, because we have one of the parties got backed financially by the cigarette players, and one of the other parties has other people in the illicit cigarette industry. So one has a combination of both sides of the same coin, and it's a problem. So I think there are pockets that have political will to deal with it, and we just need one of those pockets to have enough gumption to make it happen.
Alexa, this concept of increased enforcement, risk areas and so forth, we've seen a few comments coming through as part of the minister's budget speech earlier this year. And again, we've seen some noises coming through from SARS. Could you give us an idea in terms of what you expect or where you expect SARS to be looking over the course of the next year?
Sure. I think in the supplementary budget speech, specific mention was made of the fact that increased enforcement of tax collections will be a very strong focus point in achieving fiscal stabilization at this point in time. So I think for the general taxpayer, that means that they can expect SARS to be a lot more focused on tax compliance as a general point, as well as the collection of outstanding taxes. So I think taxpayers may expect more queries from SARS, more follow-ups, and perhaps more related to corporates. SARS indicated that they'll be focusing on international tax, specifically related to cross-border transactions and transfer pricing issues in relation to parties, a multinational enterprise not charging arm's length prices for cross-border transactions with group parties, group companies, and connected persons. So I think that's a specific focus point that'll be very much in the spotlight at SARS. We have seen SARS increasing their transfer pricing department internally quite drastically over the past few months. And queries are starting to arise from that department in relation to cross-border transactions. So I think it's a very good time for multinational enterprises to get the necessary advice and to ensure that they are 100% compliant in that field. In addition, it was indicated that SARS will be focusing on what they termed syndicated fraud related to VAT refunds, as they have experienced quite a bit of issues in that specific area. And lastly, I think the focus will be more and more on SARS using third-party data to find non-compliant taxpayers. And one of the aspects that I think they'll be focusing on in that regard is the Common Reporting Standard, which is a global standard which revenue authorities use to gather information on individuals or corporate taxpayers that harbor assets offshore without declaring them in, for example, South Africa. And I think that ties in with Paul's comments earlier in relation to the historic amnesty and voluntary disclosure programs. SARS now has the means of finding those non-compliant taxpayers with assets offshore. So I think if there are taxpayers out there, and they definitely would be, that still have assets offshore which have not been declared to SARS, now would be as good a time as ever to proceed with a voluntary disclosure application. And finally, I think another aspect of third-party data that SARS will be using more and more, and which we have been seeing them checking up on quite a lot, is they often request bank statements from taxpayers, and then they compare on a transaction-by-transaction basis the in and outflows of those bank statements with what is declared on an income tax return. So it's important to ensure that all transaction flows through a bank statement can be explained with reference to your income tax return.
This use of third-party data is quite an interesting concept, because we've seen in our practice, we would get letters from SARS without any pre-request for bank statements saying, "Dear Joe Soap, you've received 10 million Rand into ABSA bank account number 567. You've only declared 8 million Rand on your tax return. Please explain the variance." I know we've certainly seen a couple of those letters to date. I would imagine, Paul, Deon, you've seen a couple of those come through in your practices as well?
Yes, particularly where taxpayers haven't rendered a tax return. It's being used as the basis for the estimated assessment that SARS intends to raise. So yes, we are seeing a lot of those.
Yeah, I mean, even from our side, slightly different circumstances perhaps, but we often see SARS wanting clients to reconcile the revenue figure per their financial statements back to deposits received in the bank accounts. Now, obviously, some of those credits to the bank statement, you know, there could be timing issues, could be debtors that pay, but the sale was recognized in the prior year. There could be intercompany transfers and all sorts of things like that. So, you know, one just needs to question, is that the best approach? And maybe one's got to just maybe sort of scope and sort of identify the right client. I agree, to the extent you haven't submitted a return, as Paul explained, that's, you know, quite, you know, there's no other basis perhaps for them to raise the return and you know, to raise an assessment rather. But, you know, I see some of these clients, it's quite a onerous process, especially if you've got high volume transactions going through the bank account to deal with that. Obviously, if you've got proper records, you know, it can be done. It's just the administrative burden of dealing with that.
And I think following on from that, we've also seen that when assessments are raised, we then see in terms of the Tax Laws Amendment Bill that there's quite hefty penalties charged, anywhere between 10 and 200%. Paul, this is becoming a bit of a minefield, because as an individual taxpayer, to navigate the tax complexities and worry about whether or not you have or haven't declared everything exactly in terms of the law gets incredibly complex. What should taxpayers be doing to safeguard themselves against these sort of inquiries or against a penalty being levied out of the woodwork a year or 2 years down the line?
Well, I think on material transactions, people need to have formal written opinions in order to minimize the potential penalties, because you have to be able to show that you took reasonable care in completing your return. So I think proper professional advice is required. And people certainly need to be up to date and compliant with their tax affairs. The days of having 3 or 4 years outstanding is going to be over very, very soon, with the penalty assessments, the estimated assessments with 100% understatement penalty being imposed on gross negligence is certainly going to be enough of an incentive to bring your affairs up to date.
Yeah, I think of late, we have even seen a few letters coming through from the SARS Criminal Investigation Unit for non-submission of returns. And that entails or extends even through to dormant companies. Is there an exercise, again, that the taxpayers should be conducting maybe on any companies where there are directors or that they are associated with?
Well, I think certainly as a group, there should be somebody looking at tax compliance status on a regular basis. One, to find the things that fall through the cracks, and certainly also to find these funny assessments that get raised by journal or other methods on the SARS system without a formal notification that pop up from time to time with a liability. And if you don't deal with those timeously, you will be out of time to object to both the capital and the understatement penalty that would be raised. So it's important that people look at their compliance status regularly.
This concept of criminal prosecution for tax-related matters seems to be a bigger and bigger deal in the eyes of SARS. And I think, Deon, out of the latest round of amendments to the Tax Laws Amendment Act, we've seen a few changes proposed, not only to tax legislation, but also to criminal prosecution for non-compliance.
Yeah, I mean, Ziyaad, yeah, it's an interesting one. It's almost like SARS and the National Prosecuting Authority wants to lower the bar, where, you know, currently as things stand, there's got to be intent. So they refer to willful and without just cause. So SARS or the National Prosecuting Authority, in order to criminally prosecute, they need to prove that there was intent on the side of the taxpayer. Now, what I mean by lowering the bar, they now want to move from that intent to almost go and look at negligence. So almost, you know, if a taxpayer was, you know, negligent, or, you know, maybe they didn't know better, there's a chance they can be criminally prosecuted. So I think, you know, there's been a lot of pushback. I think everyone who commented was not happy about this. I think there's a lot of pushback in practice. I think this is going to make, you know, life easier for SARS to just prosecute someone for being ignorant and negligent. And I think that's not the intention here. I think there's still, you know, maybe some onus on SARS to prove that you know, willfully and with intent acted in a particular manner. You know, SARS also has other remedies at their disposal, penalties and fines, which they can institute for non-compliance. So it almost means that if you were negligent, there's a chance of being criminally prosecuted. So, you know, if this comes through, I think clients will need to make sure that they stay up to date, stay compliant, and we'll probably see a lot of VDPs coming through the system, because that's the only way you can avoid being criminally prosecuted. So, you know, I hope that they do see the light and this change doesn't come through, because I think it will have far-reaching consequences for taxpayers.
Yeah, it just sounds crazy that you could potentially be locked up for not notifying SARS about a change in your postal address or physical address or contact details, you know, when there are bigger fish to fry. But there were a few changes that were also tabled as part of the Tax Laws Amendment Bill, some good, some not so much. Can you chat us through some of those as well, please?
Yeah, I'm going to highlight two, and these were instances where, you know, probably, you know, the interpretation was a bit aggressive from taxpayers, and SARS quickly picked up on that, and Treasury are trying to sort of stop those loopholes or sort of aggressive interpretation by taxpayers. The one deals with bona fide bursaries. So where an employer, you know, provides a bursary, for example, to the, you know, to a child of one of the employees, there's a threshold of 600,000 that, you know, you need to earn less than that amount. So there was a scheme trying, you know, where not only just the employers, but sometimes these things would have been packaged and you get other institutions to come on board. So essentially what you do is you change a portion of your employment income from being taxable to non-taxable in the form of a bursary. And the problem they had with this is the salary sacrifice. And SARS categorically said there's no chance of doing firstly a salary sacrifice, and the other thing that they also said is that you need to have a, you know, this bursary open to the general public, which I think is maybe a bit too difficult and quite onerous. I think what is important is that the bursary needs to be available to all employees within the organization, and that everyone should be able to apply. It can't be limited to the directors' children, for example. So I think that's reasonable that it needs to be open within the organization, but to make it to the general public, I think might be quite difficult. We live in a country where skills and education are, it's a critical thing, and if we can get some funding towards it, that's fine. But obviously the abuse that SARS are trying to curb here was the element of salary sacrifice. And they've gone as far to say that the employer who grants this beneficiary won't be able to get the income tax deduction in a scenario where there was a salary sacrifice. So I would think this one will probably go through in a very similar fashion to what is drafted at the moment. The other thing, and I sort of touched on this a bit earlier, was Section 7C. And as I explained, and this is quite a technical provision, so this is not the intention of my explanation here is not to be a course on 7C, because that could keep us busy for a lot of hours. So again, 7C was introduced just to curb this transfer of wealth to a trust. And as I explained earlier, you do a sale on loan account, you don't charge interest on the loan, or it's at a very low interest rate, and annually there's a deemed donation. It's not only just the individual providing the loan to the trust, but it could also be where that individual's got significant influence. And at the instance of a individual, a company, and typically the company that is owned by a trust, so let's say more than 20% of the shares in the company is held by a trust, now makes an advance, or you make an advance to the company then on-lends the money to the trust. So SARS is trying to curb that, and that was sort of the second anti-avoidance rule in terms of 7C. So what a lot of taxpayers now have done is, instead of just doing a loan to the company, they would subscribe for preference shares, also paying a low interest rate, and that would be a way of sort of curbing and working around 7C. And SARS have now said, well, if you're going to do that, you're still going to have that deemed donation. And so again, it's almost taxpayers taking advantage and trying to find loopholes and working around it. And the interpretation is clearly not against what the intention was of these provisions. So I do think that provision will probably go through in a similar fashion to what it's worded at the moment. Of course, there are sometimes some good provisions and so on, but I'm just going to highlight this just in the interest of time.
Alexa, one of the other things we've seen is the potential change in the immigration legislation and this concept of financial immigration and the ability to remove funds outside of South Africa depending on your tax residency.
Yes, in terms of current law, lump sum benefits can be paid by retirement funds to an individual that withdraws from those funds prior to retirement age, if that individual immigrates for exchange control purposes. However, in February, during the budget speech, it was announced that there will be a move away from very stringent exchange control rules in South Africa. And one of the aspects that they are looking to move away from is this formal exchange control immigration process. And as a result, the tax bill has now proposed, once the exchange control immigration process is done away with, the lump sum benefits may be withdrawn by an exiting taxpayer or individual from South Africa. But because the exchange control immigration process will no longer be there, the proposal is that that individual would only be able to withdraw his retirement funds 3 years after ceasing to be a South African tax resident. Now, maybe at that point will be a good time to just take a step back, because I do think there's a lot of misinformation in the market in relation to exchange control immigration and ceasing your status as a South African tax resident. Exchange control immigration is a process that's attended to by your bank. It often goes hand in hand or runs parallel to ceasing to be tax resident, but the one process is not dependent on the other. It is quite possible to lose your status as a South African tax resident while still remaining an exchange control resident of South Africa, and vice versa. From a South African tax perspective, whether you are a South African tax resident is dependent on principles as contained in the Income Tax Act. And to lose your status as a South African tax resident, the process of doing so is quite simple. It's actually just a tick box in your income tax return. But before you can actually tick that box, there's quite a lot of detail to consider in relation to whether you still adhere to the residency principles contained in the Income Tax Act. Analysis to be done, and which individuals should preferably get a tax opinion on. In addition, once you tick that box in your income tax return, you need to be satisfied that you know what the tax effect of doing so would be. Because if you tick that box, it would mean that you dispose of your worldwide assets at market value, other than assets relating to South African immovable property. So when you cease to be a South African tax resident, the tax impact of doing so could be quite severe, which is also why it's preferable to get advice in that specific area before you do that tick box. And to come back to the proposal to only be, for an individual to only be in a position to withdraw retirement funds 3 years after ceasing to be tax resident, I think it could create some cash flow issues for individuals exiting South Africa, because often they would do the exchange control immigration process together with the tax exit process, and then use their retirement funds to make payment of that capital gains tax exit levy, which, if this proposal comes through, would not be possible.
So we've seen a lot of advisors indicating that clients should be going through this Reserve Bank process and going through a financial immigration process at the South African Reserve Bank. At this point in time, do you think that that's the right approach, or should there be a wait-and-see approach adopted until such time as the legislation is enacted? What does the client do at the moment in terms of this concept of financial immigration, Alexa?
I think each case should be determined on its own facts. There's no right answer that can give a blanket answer to everyone. I do think a lot of people are following the wait-and-see approach, but it depends on the need of that specific individual to get funds offshore or not. And I think it would be best if someone is in that position to get the necessary advice accordingly.
If I might add, I think the one thing is, for many people, they actually ceased being a resident many years ago. They've left, they've been working abroad. It meant nothing to them because they had no South African interest income, they might have had no South African income at all, and all of their foreign remuneration was exempt. Now it means something, but the date when they actually ceased residence is possibly the date they got on that plane and they said, I'm never coming back. That's when they ceased being ordinarily resident. Or the date when, in terms of a double taxation agreement, they'd been in their new country for 183 days, they had a home and they had no home in South Africa, they had the cat and the dog in their new home. All of those factors probably meant they ceased being a resident some 5, 10, 15, 20 years ago. And that's the test, and that's the issue. Everybody's making a hype about the Reserve Bank, but the issue of when do they cease residence, because they might have ceased residence after capital gains tax came in and not made the disclosure, and now have to consider a voluntary disclosure program to regularize that. And that is the issue that they need to take proper professional advice on.
But I do agree. I mean, there's a lot of advisors out there just going on financial immigration and going on about the SARS process, but you've got to do the SARS process. And I agree. And it often, even though, yes, there might be a VDP, it's better to trigger your exit charge, 5 years, 10 years ago when you left, because possibly your wealth would have been less then, if we ignore maybe the impact on valuations for COVID. But typically, that would be far worse sort of exercise to go through, and then go through the VDP and possibly, better if you want to get a tax opinion from your advisor just to be safe. And that will help maybe with any future penalties as well.
It comes back to this concept of tax planning well in advance, because a lot of these issues in terms of jumping on a plane, were the forms filled out at that point in time 10 years ago, you would have avoided all of these challenges today. I think on that note, just in terms of what we've been chatting about around potential changes in legislation, Paul, should there be steps that clients should take now in terms of restructuring or setting up their affairs in a more tax-efficient structure, given some of the pending legislation changes?
Yeah, I think that the change to interspousal donations is imminent. And even if I'm wrong, there's no harm triggered in doing some interspousal donations. So, I mean, we still live in a fairly traditional male-dominated society that most of the asset wealth is sitting in the husband's name. And we need to ensure that the spouse has at least 5 to 10 million rand, or somebody who's got substantial wealth in their own name, to ensure that they will have the benefit of an abatement on their death, and that they have some wealth in their own names anyway. I think it's an important process to begin. There's no negativity in doing so, but certainly if the law changes and the law changes with immediate effect, it will be important that this is done pre those change times. So I think that's important to do.
There's also the discussion around looking at moving assets around, given that valuations of companies in particular may be low, given lower profitability during COVID. Is now an opportune time to potentially look at that while valuations are low?
Yes, I think this is a time for a family type restructure, business type restructure. If people have assets in their own names, it's the time to do that. If people are splitting out businesses into different pots for different reasons, this is a very good time for all of those restructures to take place. One of the other things that people should be looking at, and this is not dependent on value per se, but interposing between the trust that holds your trading company, another investment company, so that dividends can leave your trading company without dividends tax being imposed. I think that's an important planning thing that people should take advice on. We have a number of corporate restructure people within the firm who can give advice on those relatively simple restructure plans that will minimize dividends tax.
I'm just conscious of time as we head up to 10 o'clock. There have been a couple of questions that have popped up. So maybe if we can deal with that just before we move to closing thoughts. I think we'll just deal with them in the order in which they came in. And Paul, maybe I can ask you just to deal with this one. Does PKF have any indication of how aggressive SARS will be chasing collections by disallowing expenses necessarily incurred due to COVID, but not directly in the production of income? For example, a 2-week overseas business trip extended by a few months due to lockdowns and quarantines, plus the added accommodation and related travel costs.
I think that one of the key tests there will be actually incurred. So one has to have shown proof that those expenses have been actually incurred, and it would be best that they were actually incurred by the company employer and not necessarily just reimbursed. That also is going to be slightly harder to defend, but actually incurred trumps necessarily incurred. And as long as one can show that that employee was still contributing to the company in the same way as he would have been in lockdown in South Africa, if he's locked down in a luxury 5-star hotel somewhere, if he's still able to contribute to the company's activities similarly to that he would in South Africa, I think one would have a defendable position. Yes, it's probable that there'll be queries raised because your overseas travel is going to be significantly higher than in prior years, but I don't think that's going to be something that will be a complete stumbling block for a possible claim or defense to a claim. I mean, there are going to be COVID costs that will be incurred. Those are necessary for the running of your business. All of this PPE, all of these cleaning and cleansing things, that's all going to be a deductible expense under the normal rules.
Thanks, Paul. Deon, if I can pass the next one to you. For clients who implemented, again, relating to Section 7C and the trust structures, for clients who implemented a preference share structure to obviate the Section 7C requirements, what do they do now? So if you already have implemented that structure, should you relook at it given the pending changes?
I think the main thing is just have the correct interest rate. I think the issue here is if you go at a low interest rate. So the requirement is repo plus 1. That is the official SARS interest rate. I think it's 3.5 plus 1, so you get 4.5%. So you pick the right interest rate, you're fine. If the interest rate is 1, obviously that difference is going to be a deemed donation. So as long as you get that rate right, there's no problem. I think it's quite specific. It's just sort of the mischief here is the interest rates. If you get that right, it can still work. So it's not like the whole pack of cards going to come falling down.
Okay. Alexa, in relation to foreign exchange and amnesty, there's two questions there. The first is that, is it better for an individual who has not submitted returns for approximately 6 years to start the VDP process to avoid criminal prosecution? That's the first. And the second relates to voluntary disclosure. So the question is, I've got existing overseas investments via Old Mutual and Ellen Gray. Would we suggest a voluntary disclosure?
I think in relation to the last question, if those assets have not on prior occasion been declared to SARS, then yes, I would suggest considering whether the voluntary disclosure application requirements are met and whether we can proceed with that. I think that would be a good idea to avoid penalties. Of course, interest is not easily waived by SARS. It's only in very specific and limited circumstances will interest be waived, but the VDP will assist with the penalties. In relation to the non-submission of tax returns, unfortunately, that is not something that the VDP relief will be afforded for. What would be the better approach would be to catch up on those tax returns and to rather, as and when penalties and interest are raised, submit an objection in relation to the penalties and try and see if we can reduce that on that basis. But unfortunately, a VDP would not be possible.
Okay, thanks. I think that's all the questions answered. Again, we're running a little bit over, so I'll take maybe closing thoughts from each of the panelists, and we'll end the session on that basis. Paul, maybe do you want to go first?
Yeah, look, this is a very, very difficult and strange year, and I think SARS is going to have to take different mechanisms to try to restore some level of normality, and government certainly needs to step up to the plate to create that necessary framework for a normal return of the economy.
Yeah, Ziyaad, I mean, you asked me earlier about where can they grow tax. Well, if the economy grows, we're going to collect a lot more tax, and then we don't need to get creative about all sorts of estate taxes and all of that. So if we can stimulate the economy, that'll be great. But I did also speak earlier about, you know, the potential change in criminal prosecuting. If that comes through, we're in for a bit of a rough time. So I think it's quite important clients keep their tax affairs up to date. Make sure someone monitors their tax compliance status. They can contact the PKF office and make sure we assist them with that. I think it's going to become more important going forward, especially now. So I was trying to collect money. You're going to see probably more of these estimated assessments coming through. So now is the time to stay compliant.
Yes, I agree with Deon. I think the takeaway for the average taxpayer out there after the impact of COVID on the economy would be to ensure that they are as tax compliant as they have ever been, and to ensure that everything is up to date and get the necessary advice to make sure that there are no aspects which are outstanding and in respect of which penalties can be levied by SARS, because I would expect that SARS would also be not be that sympathetic in hearing arguments to waive penalties at this point in time, because they are looking to raise additional revenue.
And I think on that note, we'll end the session. Thank you all for attending. Thank you very much for the time. I see there have been a few questions in the chat box relating to CPD certificates. Kelly from PKF South Africa Marketing will send out an email to all of the attendees with a survey together with a video link. So you can simply respond on that if you do need a certificate. Again, thank you very much for the time, and we hope you enjoyed the session.